Tata Motors shares took a significant hit today, plunging by around 5% to close below the 1,000 rupees mark. This sharp decline was triggered by UBS, a leading global investment bank who maintained a sell rating on the company's stock. The sell rating from UBS, coupled with concerns over the impact of price cuts on Tata Motors' profitability, led to a sell-off by investors. So anyway, let's jump into these details. The story begins with UBS reiterating its sell rating on Tata Motors. The investment bank has also mentioned a price target of Rs 825 for Tata Motors and expects a further 20% downside. But wait, what are the findings of the UBS report? The report cited potential downside risks, particularly pointing to margin pressure at Tata Motors' luxury brand, which is Jaguar Land Rover, and within the domestic passenger vehicle segment. If you see the image on the screen, the luxury segment, Jaguar Land Rover, recorded revenues of 71,396 crores in the first quarter of fiscal year 25. This translates to around 70% of the total revenue generated by Tata Motors. Currently, the EBIT margins stand at 8.6% for JLR and 1% for passenger vehicles, and UBS expects the margins to be at pressure moving ahead. Additionally, UBS reported that the demand for Jaguar Land Rover, particularly for the Defender, Range Rover and Range Rover Sport, have started to moderate. Furthermore, the order book for these cars has now hit the pre-COVID levels, thereby affecting the overall profitability for Tata Motors. A point to note is that the strong sales of JLR's premium models have so far boosted the average selling price for Tata Motors, and hence concerns over a moderation in demand may impact its margin performance. But if you look at the overall level, this moderation in sales is felt throughout the country, with all other automakers affected. Dealers have been struggling with inventory levels at showrooms remaining at alarming levels, with stock days now stretching to 70 to 75 days and inventory totaling 7.8 lakh vehicles valued at an alarming 77,800 crores. Adding to these challenges, Tata Motors recently announced significant price cuts across its electric vehicle lineup as part of the Festival of Cars campaign. The offer, valid until October 31, aims to make EVs more affordable and boost adoption in India, thereby increasing the sales of its vehicles. Additionally, Tata Motors announced that customers can enjoy 6 months free of cost charging at any of the 5,500 plus Tata Power charging points across the country, making both inter and intra-city journeys hassle-free as well as cost-free. Now, to quickly conclude, the UBS sell rating and concerns over price cuts sent Tata Motors stock spiraling downwards. The stock price plummeted by 5.7%, raising concerns about the company's future prospects and its ability to deliver value to shareholders. And what could be the consequences of the price cuts? Tata Motors' decision to cut prices of its electric vehicles is a bold move aimed at stimulating demand for its vehicles. However, the price cuts also have potential consequences. Lower selling prices could lead to a decline in profitability, especially if the company is unable to offset the cost reduction through operational efficiencies. The price cuts could put pressure on competitors to follow suit, intensifying competition in the Indian electrical vehicle market. The long-term sustainability of this strategy depends on Tata Motors' ability to achieve economies of scale and reduce costs over time. Having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.